When I first started trading, I traded chart patterns like guaranteed cheat codes. I thought if I simply memorized the right shapes, I could bypass the hard work of actual analysis. It was a mindset that cost me thousands. Take this isolated candlestick, for example. To a rookie, this hanging man shape looks like a standalone sell signal. You see the long lower wick, and you think the move is over, so you sell. But market analysis isn't an exercise in geometry. These shapes fail constantly because they are often just random noise created by a handful of orders rather than a meaningful shift in the crowd. A pattern viewed in a vacuum is a gamble. To find a genuine edge, you have to look for the specific human pressure that forced that shape onto the screen in the first place. Beneath the lines and bars, a price chart is a historical map of collective fear, greed, and panic. It tracks exactly how buyers and sellers are reacting to the world in real time. These patterns often become self-fulfilling because millions of people are watching the same levels. When the crowd sees a certain price reached, they tend to react the same emotional way, which accelerates the move. If you want to stop losing money, you have to stop hunting for magic shapes and start learning how to read the broader story being told by the market. That story begins at the microscopic level, with the anatomy of a single candlestick. These solid bodies show us conviction. They record exactly who won the battle for that specific period, showing the distance between where the price opened and where it finally closed. The thin vertical shadows, or wicks, represent failure or rejection. They show us exactly where one side tried to push the price before the other side gathered enough strength to beat them back. When we zoom out, we see these battles aggregate into support and resistance lines. These are memory zones where traders are waiting to ambush each other. The price bounces here because this is where the market participants remember past profits or losses. Every wick and every bounce off these lines is a permanent record of buyers and sellers fighting for control of the trend. In an active uptrend, the market eventually loses steam. It needs to rest before it can continue higher. This is a continuation pattern called falling three methods. Those three small candles trapped between the two large red ones represent a temporary interruption, not a reversal. Psychologically, the dominant bulls are simply catching their breath. Meanwhile, the bears are making a weak attempt to take over, but they lack the volume and conviction to actually turn the tide. We call this a break of structure. When the price finally pushes past its previous high, it confirms that the dominant force has resumed control and the trend is still healthy. Patterns like this prove that the underlying trend is merely pausing rather than dying. But what does it look like when a trend actually ends? We have to look for signs that demand is genuinely exhausted. This triple top pattern is a prime indicator of that exhaustion. You can see three distinct peaks hitting the same ceiling, each one representing a failed attempt by buyers to move the price higher. On a larger scale, this leads to a buying climax. At the point marked BC, the public is buying aggressively out of greed, while large institutional players are quietly unloading their shares into that demand. This exhaustion eventually creates a change of character. Notice the point marked SOW, or sign of weakness. The price drops decisively below its support level, signaling that the trend has officially flipped from bull to bear. Identifying this specific structural failure is the difference between getting trapped in a dying trend and actually profiting from a reversal. Applying this in the real world requires a specific sequence. You don't just jump at the first shape you see. You first identify the macro trend, then you wait for a structural shift like a change of character. Only then do you look for a candlestick pattern to validate your entry point. Professional traders use these charts as tools to quantify exactly where their thesis is proven wrong. Identifying those memory zones of support and resistance tells you precisely where you must place your stop losses. If the price breaks those zones, the story has changed, and it's time to exit and protect your capital. The market is a massive repeating mirror of human emotion. It is a force you cannot fight. You can only learn to navigate it. Master your own emotions, learn to read the fear and greed of the crowd on the chart, and you will stop gambling and start trading.